The Fed didn't just cut rates. It quietly admitted the old playbook doesn't work anymore. And depending on which thumbnail you clicked this morning, that same decision apparently means new bull market, imminent recession, soft landing, and global reset all at once. So how can one move by the same group of people in the same building mean boom, bust, and reset at the same time? That's what we're unpacking today. Not hype, not doom, just a way to think like an adult investor instead of a dopamine-addicted algorithm. Welcome back to the comment section with Thomas Paul. This is basically Reset Part 2, the okay now what, after the Fed pulled the trigger. Quick disclaimer before we break the internet. Nothing in this video is financial, legal, or tax advice. This is for education and entertainment only. I'm not your advisor. You're responsible for your own money, which is both terrifying and empowering. Do your own research, talk to a pro, and never make big money moves based only on a YouTube video, even this one. All right, let's start with what the Fed actually did in plain English without 47 acronyms. The Fed just cut interest rates. Not to zero, not into some sci-fi negative rate zone, but they lowered the federal funds rate by a noticeable chunk, and more importantly, they changed the story around it. On paper, they said a few key things. Inflation is down from the peak, but still above their 2% target. The labor market is cooling, which is a polite central bank way of saying, we're starting to see some cracks, but please don't panic yet. And in the famous dot plot, that little chart where each Fed official gets to put a dot on where they think rates are going, they basically signaled, we're now in cutting mode. Maybe not super fast, but the direction has changed. What makes this wild is how quickly they pivoted. Not long ago, the same people were out there saying, higher for longer, we will keep at it. We're not declaring victory on inflation. And then suddenly, cut. Markets don't just react to where rates are. They react to the speed and direction of change. It's like driving. Going from 80 to 60 slowly is one vibe. Slamming the brakes from 80 to 60 because you just saw a wall is a very different vibe. And here's where things start to get interesting. This cut is more dangerous than your classic, oh no, recession, let's save the economy cycle for a few reasons. First, they are easing with inflation not fully back at target. In the textbook, you hike rates until inflation is dead, then you keep them there a bit, then you gently cut when the coast is clear. In real life, they're doing, inflation is better, but not solved, and the economy is slowing, and everyone hates us. So let's start cutting and hope it all works out. Think of it like antibiotics. The doctor tells you, finish the full course or the infection might come back worse. The Fed just said, hey, we've done most of the pills, let's stop early and trust the vibes. Second, they're data dependent, in a world where the data is glitchy, delayed, and constantly revised. We've seen months where inflation looked hotter, then got revised cooler later. Jobs numbers get printed, markets freak out, then quietly adjusted a month later when nobody's watching. So when the Fed says we're following the data, it's partly we're flying a plane using gauges that keep changing after we've already moved the controls. Third, there's enormous political and market pressure not to trigger a hard landing. Nobody wants higher unemployment into an election season. Nobody wants a housing crash on their watch. And markets have become so addicted to cheap money that the second the Fed even hints at easing, Wall Street runs ahead and throws a party. And that's the fourth problem, the global backdrop. We're cutting into a world where debt levels are already bloated, asset prices are already stretched, and geopolitics look like a group project where nobody did the homework. In past cycles, rate cuts came when inflation was low, assets were cheaper, and the big question was, how do we restart growth? Now it's, how do we avoid blowing up a giant debt and asset bubble while also not crashing the economy? So no, this isn't a normal, phew, recession is here, let's slash rates and reset moment. This is more like trying to do surgery while the building is on fire and the fire department is arguing about politics on social media. But wait, it gets even wilder when you zoom out globally. Let's talk about Japan, the slow-motion train that might actually matter now. For decades, Japan has been the poster child of permanent low rates, aging population, weak growth, insane government debt, and a central bank that basically said, we will keep borrowing costs near zero forever. Please clap. They even did yield curve control, which is a fancy way of saying, we're not just setting short-term rates, we're also going to sit on the long-term bond market and force yields to stay low. That worked, until it didn't. Because when the rest of the world starts hiking, like the US did the past few years, and Japan stays pinned at zero, weird things happen. global investors borrow in Japan at super low rates and invest elsewhere at higher yields. That's called the carry trade. It's like financial tourism. Cheap money over here, party over there. Now fast forward to today. Japan is slowly moving away from hardcore yield curve control. Yields on Japanese bonds have started to wiggle. A little volatility there can ripple through everything from bank balance sheets to currency markets. Here's the link to the Fed cut. When the Fed pivots from hiking to cutting, global liquidity sloshes around. Money that was happy earning safe yield in U.S. bonds might start chasing risk again. If at the same time Japan's bond market starts behaving unpredictably, those lovely carry trades can unwind fast. And unwinds are not calm. They're forced selling, weird moves in currencies, hedge funds sweating through their Patagonia vests. Japan is the slow-moving risk that suddenly matters when the big central banks pivot. So if it feels like this rate cut is happening in a much more fragile system than 10 or 20 years ago, that's because it is. Now, if you open YouTube or financial media, you'll see two completely opposite reactions to this moment. On one side, massive bull market incoming, Fed pivot, cheaper money, tech to the moon, crypto back, baby. On the other, this is the first cut of the crash. The Fed only cuts when something is breaking. The consumer is stretched, corporate margins are under pressure, geopolitical risk is rising, duck and cover. So who's lying? Here's the honest answer. Potentially, neither. Let's map it on a simple framework, growth versus inflation. Imagine a 2x2 box. One axis is growth, strong or weak. The other axis is inflation, high or low. If growth is strong and inflation is easing, rate cuts look like rocket fuel. That's the bull case. Tech, housing, long-duration assets, anything that loves lower discount rates, they party. If growth is weakening and inflation is sticky, rate cuts look like admission of a problem. That's the bear case. The Fed is cutting not because things are amazing, but because something under the surface is cracking. Now add time frames. In the short term, markets respond to liquidity and narrative. If the story is soft landing plus cuts, risk assets can melt up even if the fundamentals are getting worse under the hood. In the medium term, earnings, cash flows, and defaults matter. If consumers are tired, companies are squeezed, and credit stress builds, you can absolutely have a blow-off top followed by a nasty hangover. So yes, the urgent warning crowd and the buy now crowd can both be right, just not at the same time in the same assets for the same audience. This is exactly why I said before, a lot of big channels aren't actually disagreeing on reality. They're choosing which slice of it to optimize for. And here's where things get even more useful. Let's bring it down from macro charts to your actual life. What does this rate cut regime shift mean for your mortgage, your credit cards, your car loan, your small business? First, mortgages. People hear rate cuts and think, cool, housing is affordable again. Not so fast. The Fed controls short-term rates. Mortgage rates are tied to longer-term bond yields, which care about inflation expectations, growth, and risk. If the market thinks rate cuts mean higher future inflation, long-term yields might not fall much, or could even rise. So you could end up in this annoying zone where home prices stay high because sellers refuse to drop, mortgage rates come down a bit but not enough to make it cheap, and payments are still painful. Housing affordability is a function of three things: price, rate, and income. The Fed can nudge one of those. The others are your boss and the housing market. Next, credit cards and car loans. Here, cuts can help a bit more directly, but slowly. You might see some relief on variable rate debt over time, but banks also love wide spreads. If they can keep charging you 20% on a card while their funding costs drop, trust me, they will. Small businesses. Rate cuts can make refinancing slightly less awful, extend the life of zombie companies that shouldn't exist, and ease some cash flow stress. But if the economy slows, those same businesses may see lower demand and start cutting costs anyway, including jobs. So at the personal level, this is not some magic wand that fixes affordability. It's more like the Fed saying, we'll make the pain slightly less sharp so that everyone can suffer slowly together. And that brings us to the part people actually mess up the most. How do I make decisions in this environment without going insane every time the CPI report drops? Let's build a simple framework. Number one, time horizon. What game are you playing? The next 12 months or the next 10 years? If you need your money in a year for a down payment, tuition, emergencies, you have no business YOLOing into max volatility assets just because the Fed cut. If you're investing for 10, 20, 30 years, a single Fed meeting is background noise. The regime matters, but the exact chart on Wednesday does not. Number 2, liquidity needs. If you don't have a real emergency fund, your number one investment right now is cash buffer, not the next hot stock. Rate cuts can mean more volatility. It's deeply unpleasant to be forced to sell at the worst moment because your car exploded and you have no savings. Number 3, concentration in rate-sensitive assets. If your entire life is tied to one quadrant of the macro world, your job is in tech, you own a tech-heavy portfolio, you live in a high-beta housing market, and you just took out a big mortgage. You're basically a leverage bet on low rates forever. In a regime shift, that's not diversification, that's a personality flaw. You don't need to become a bond trader, but you should know if you are overexposed to rate-sensitive stuff and whether you're comfortable with that. Number 4, behavior. How do you avoid getting whipsawed by every Fed presser? A few boring but powerful things. Automate your investing schedule so you're not trying to time headlines. Avoid leverage unless you fully understand how quickly it can blow you up in a regime shift. Hold some dry powder if that fits your plan. Not so much that you never invest, but enough that you can survive and maybe take advantage of real dislocations. And stress test your personal finances for both scenarios: higher for longer inflation or a shallow recession with job risk. Ask, if my expenses rose 10% and my income dropped 10%, what breaks first? Because the real macro risk for most people is not your ETF going down 15%. It's losing a job with no savings in a world where rent, food, and debt payments stay high. Now let's talk about something almost nobody links to the Fed, but absolutely should: trust. When cuts don't feel like they help Main Street, when housing's still unaffordable, wages feel stuck, and asset owners get richer, you get political backlash. People start questioning why central banks exist, whether they're captured by Wall Street, and whether the system is rigged. We already live in a world where institutional trust is scraping the floor. Political violence is more frequent, conspiracy content is a business model, and every big event instantly turns into, who's lying to me this time? That trust deficit is not just a cultural issue, it's a macro variable. Low trust means higher political risk. Higher political risk means higher risk premiums. Investors demand more return to hold assets. That can mean higher borrowing costs, more volatility, and less willingness to fund long-term, boring, productive projects. And here's the dangerous loop. If this Fed cut doesn't deliver what people expect, if inflation rekindles or inequality widens again as asset owners win, you get even more anger, more populism, more radical policies on the left and the right. Now imagine that happening in a system already stuffed with debt, bubbles, and geopolitical tension. One policy mistake, one market shock, and the lack of trust makes every reaction more extreme. So when I say this rate cut is part of a bigger reset, I don't just mean markets. I mean the social and political backdrop that markets silently price every day. Let's zoom out one last time. Every generation gets a regime shift. In the 1970s, it was inflation and oil shocks. In 2008, it was the global financial crisis and the beginning of zero-rate world. In 2020, it was the pandemic, money fire hoses, and the fastest everything bubble you've ever seen. This current period, the move off zero, the inflation spike, the rapid hikes, and now this early risky cut, is the opening chapter of the post-zero rate regime. It's not about this one meeting. It's about the Fed essentially admitting we can't go back to the old script. We're in a new, messy, semi-inflationary, debt-heavy world where the room for error is tiny. So instead of asking, is this a crash or a melt-up, I think the better question is, how do I build a portfolio and a life that can survive either? That means don't build a strategy that only works if the Fed perfectly sticks the landing. Assume policy errors. Assume weird shocks. Assume that at some point, both the bulls and the bears will look like idiots on a 6-month chart. You don't control what the Fed does. You don't control what politicians tweet. You control your savings rate, your skills, your diversification, your use of leverage, and your emotional reactions. The regime has changed. The old playbook is broken. But you don't need a perfect forecast to navigate it. You need a robust plan that doesn't blow up when the forecast is wrong. If this helped you cut through some of the noise, do me a favor. Hit like so more people actually see grounded content in between the end of the world and infinite upside thumbnails. Subscribe to the comment section with Thomas Paul if you want more frameworks and fewer vibes. And drop your hot take in the comments. What's your biggest money fear in this new regime? Job loss, housing, inflation, market crash, or something else entirely? I read a lot of what you post, and it helps shape which part of this chaos we break down next. Stay rational, stay curious, and I'll see you in the next one.